Most people tell themselves they'll start investing when they have more money. But here's what I know after years in this space. That moment rarely comes. Life has a way of expanding expenses to match income. The investors who succeed aren't the ones who wait. They're the ones who start. $100 can change your financial trajectory, not because it's a fortune, but because it breaks the inertia. Today, I'll show you exactly how to make that first move count. Let's start with what really matters, your mindset. Investing isn't gambling, and it isn't about outsmarting markets. It's about harnessing two forces that have built wealth for generations: compound growth and disciplined behavior. Think of each dollar as an employee. When you spend it, that employee works once and disappears. When you invest it, that employee works for you indefinitely, earning returns, which earn their own returns, creating exponential growth over time. The investors I've seen fail aren't the ones who started small. They're the ones who never started at all, or who let emotion override strategy. Your job isn't to invest perfectly. It's to invest consistently. Step 1. Define your why. Before you put a single dollar to work, answer this. What am I building toward? Is it retirement security, a down payment, the ability to weather an unexpected job loss without panic, freedom from financial anxiety? This isn't just motivation. It's your decision-making anchor. When markets drop 15% in a month, and they will, your goal is what keeps you invested instead of pulling out at the worst possible moment. I've watched too many people abandon solid strategies because they never clarified what they were investing for. Be specific. Financial freedom is vague. Having $50,000 in investments within 10 years is a target. Step 2. Choose the right platform. Not all investment platforms serve the same purpose. Here's how to think about them. For hands-on learners who want education built in, Fidelity or Schwab offer robust tools and research. For total beginners who want simplicity, Acorns or Betterment handle decisions for you with automated portfolios. For cost-conscious investors, Vanguard has rock-bottom fees, but a less intuitive interface. For flexibility, SoFi or Robinhood offer fractional shares, letting you invest any amount. Don't overthink this choice. You can always transfer accounts later. What matters is opening one now. The process takes 15 minutes. Verify your identity, link your bank account, and fund it. Step 3. Start with index funds or ETFs. Here's a principle that took me years to fully appreciate. You cannot consistently pick winning individual stocks. Neither can professional fund managers. Study after study proves this. What works? Buying the entire market through index funds. An S&P 500 index fund gives you ownership in 500 of America's largest companies: Apple, Microsoft, Amazon, but also healthcare, energy, consumer goods. When you buy one share, you're betting on the American economy's continued growth, not on your ability to predict which CEO will succeed. For your first $100, I'd recommend either SPY, VOO, or IVV, S&P 500 ETFs for growth-focused investing. VTI for total stock market for even broader diversification. These aren't flashy, they're foundational, and over decades, they outperform the vast majority of actively managed funds. Step 4. Automate everything. This is the difference between intention and execution. Set up automatic transfers. $10 weekly, $50 bi-weekly, $100 monthly, whatever fits your budget. Make investing something that happens to you rather than something you have to remember. Why does this work? Because it removes emotion. You invest during good markets and bad, when you're optimistic and when you're anxious. This is called dollar cost averaging, and it protects you from the biggest mistake investors make trying to time the market. Let me put numbers to this. If you invest $100 monthly for 10 years at an average 8% annual return, you'll have roughly $18,000. Your contributions totaled $12,000, meaning the market generated $6,000 in growth. Keep going for 30 years, and that number becomes $150,000 from just $36,000 in contributions. That's not luck, that's math. Step 5. Master the hardest skill, patience. I need to be honest with you about what's coming. At some point in your investing journey, your account will be worth less than you put in. You'll log in and see red numbers. You'll read headlines about market crashes. You'll feel the urge to protect your money by selling. That urge has destroyed more wealth than any market crash. The investors who build lasting wealth are the ones who do nothing during downturns. They keep contributing, they stay invested, and they let time heal volatility. Every major market decline in history has been followed by recovery and new highs. Every single one. Your timeline determines your risk. If you need this money in 2 years, don't invest it. If you won't need it for 10 plus years, short-term drops are just noise. What you should not do. Let me save you from expensive mistakes I've seen repeatedly. Don't chase performance. Last year's hottest stock is often this year's disappointment. Don't invest rent money or emergency funds. Only invest money you won't need for at least 3 to 5 years. Don't check your account daily. Obsessive monitoring creates anxiety without improving returns. Don't abandon your strategy in a downturn. The money is only lost if you sell. Don't fall for get-rich-quick schemes. Crypto tips, penny stocks, day trading, these are speculation, not investing. Instead, commit to being boring. Boring investors get rich. Exciting investors get stories. Step 6. Build knowledge gradually. Once you're comfortable with your first investment, deepen your understanding. Learn about dividend investing for passive income. Explore bond funds for stability as you get older. Understand tax-advantaged accounts, IRAs and 401ks, to accelerate growth. Read about asset allocation, how to balance stocks and bonds based on your age and goals. You don't need to master everything now, but invest in your financial education the same way you invest your money, regularly and patiently. Track progress, not performance. Check your account monthly, not daily. When you do, ask one question. Am I following my plan? Your plan is to invest consistently and stay invested. If you're doing that, you're succeeding, regardless of whether the market is up or down that month. In 10 years, you won't remember the stressful days. You'll remember the compound growth. Here's what really happens when you invest that first $100. You shift your identity. You're no longer just someone who earns and spends. You're an owner, a stakeholder in global business. You've joined the investor class. That psychological shift is as valuable as the financial one. It changes how you think about money, how you make spending decisions, and how you view your future. Every subsequent investment reinforces that identity. You're not hoping for financial security. You're building it deliberately and measurably. Let's bring it together. The path is simpler than you think. Shift your mindset from someday to today. Clarify what you're investing for. Open an account and start with index funds. Automate your contributions. Stay patient and keep learning. Let compound growth do what it does best. Your first $100 isn't about the amount. It's about the momentum. It's proof that you're capable of building wealth from wherever you are right now. The investors who retire comfortably aren't the ones who had perfect timing or secret knowledge. They're the ones who started early, stayed consistent, and let time multiply their discipline. You have everything you need to begin: $100 and the decision to act. Financial freedom is where you build wealth through clarity, not complexity. Your financial future starts today. Not tomorrow, not when you have more money. Today. Now go invest that first $100.